Hello, everyone. This is going to be our first video for Unit 5, and we're going to look at education funding in this unit. We're going to start talking about different ways to pay for a college education, and in some cases, even K through 12 private education. So let's go ahead and get started. And so when we're looking at this goal can vary from client to client. Like I said on the intro slide, more often than not, we're looking at education funding goals that are related to a bachelor's degree, but in some cases, we might even be looking at graduate or professional degrees, and also even K through 12 private funding. So here's a little cartoon for you, right? That kind of speaks to the expense associated with funding a college degree. Your mother and I looked into what it would cost to send you to university. We decided it would be cheaper for us to support you for the rest of your life. I have a 15 and a 13-year-old, and as their days in high school and middle school feel like they're coming closer and closer to a close, the reality of funding college educations is growing close to home at the Browning household. So I can completely relate to that. But we kind of know what's happening in this space, right? Education costs continue to rise. Student loan debt is undoubtedly an issue that is burdening young students and even their parents. We see that as parents start to sacrifice some of their goals to help fund kids' education, either through cash flows or debts. And one of the things that we have to always realize is not all education debt is good debt. It's definitely a positive thing for people to invest in themselves, to increase their earnings potential. But we have to be thoughtful about how that investment takes place. And we just have to recognize that not all education debt is good debt. Now, thinking about education, the CFP board definitely expects the financial planner to be diligent and knowledgeable on this topic, right? There's quite the list of things that is expected of a financial planner when they're working with a client to fund education goals. And we're going to talk about all of these things as we go through our lecture here, and then also as we look at an education needs analysis from a funding perspective. One thing we need to recognize as we go through this discussion is that there is more than one way to pay for college. We're going to talk a lot about saving for college to fund the goal, right? Saving for education to fund the education goal. But oftentimes, when clients are looking at funding a goal like this, they're looking at combined strategies, right? They might use some savings, some cash flow, and then hopefully some scholarship or even assistance through government education funding programs. And so when we're thinking about this, we have to think broadly. We can't just think 529 or other education savings vehicle as the only solution to solve for this problem. We'll also think about other things, right? When we're thinking about savings, what type of account is the best type of account and what assets should that account hold? When we're considering type of account, one of the biggest considerations that we make is what are the tax benefits associated with the funding account that we're using? Even when we're thinking about paying out of pocket, right? Are there potentially tax credits that could be applied to subsidize the cost and so on and so forth? We also want to think about ownership, and we'll talk a little bit about this, but we really want to utilize some of the what I'm going to call estate planning loopholes when we think about education funding. And then as we think about funding the education goal, making sure that we keep our clients as eligible for other forms of aid as we possibly can will definitely be a consideration. So right off the bat, let's just make sure that we understand that investment vehicles and accounts are different. So we're going to talk a lot about 529 plans in this lecture. So a 529 is an account, but a 529 is not an investment, right? A 529 is an account that holds investments and provides special treatment for the investments that it holds based on its tax status. Okay, so the 529 is the wrapper that holds the investments that go inside that wrapper. Same thing could be said for a Coverdell or an IRA, even if we move into retirement, right? 401ks are not an investment, they're an account that holds investments. that receive a certain type of tax treatment while inside that account. So just wanted to clear that up right before or right off the top before we get started. Okay, so we're going to spend the vast majority of our time in this lecture talking about 529 plans, both tuition reimbursement plans and college savings plans. So that'll be the majority of our discussion. We'll touch on Coverdell's very quickly, and then we'll spend a little bit of time on IRAs, specifically Roth IRAs and taxable accounts. So there are other options for funding educations, but these are the most popular by far. And so these are the ones that we want to make sure that we address during our time. All right, so when a client comes to you with an education funding goal, here's some of the issues that they're going to be dealing with, right? How much do we need? What's going to be the total cost of funding the education? If we're saving for that goal, how much needs to be contributed over the timeline that we're dealing with? Based on what the client wants to fund for the education goal, what accounts are going to best fit those funding objectives with regards to their determination of qualified education expenses. The reason we really like 529s, Roth IRAs, is because they have very broad definitions of qualified education expenses. And so the client can use those accumulated assets to pay for basically anything related to the educational journey. We also want to consider who has control over investments, who has control over the assets, i.e. who owns the accounts that we're dealing with. We already kind of talked about the importance of considering tax issues, and then also any penalties that might come up if the funds are used outside of either qualified education expenses or their intended use, right? What happens if we save for a college education inside of, let's say, a 529 plan, and then the student gets a full ride scholarship to attend university? Is there going to be a penalty? And if so, how much? If we take those distributions for non-qualified education expenses, and also what are the tax ramifications of a situation like that? And then, like I said before, we're definitely going to consider any strategy that we're looking at's impact on eligibility for financial aid. All right, so let's start by taking a look at qualifying education expenses. So like I said before, we really like these 529 savings plans because of their very broad definition of qualified education expenses. So we'll see that tuition and fees, books and supplies, equipment, room and board, anything that would fall into one of these buckets would receive preferential treatment from a tax perspective if paid for using 529 assets. Same thing goes for Roth IRAs and even Coverdells, which are less popular than they used to be, and we'll talk about why. But really, when we're looking at this chart, what we're trying to figure out is, based on the goal, what accounts would satisfy the objective when we take distributions, right? If we take a distribution for a qualified education expense, no tax, no penalty. If we take a distribution for something that's considered a non-qualified education expense, then we're going to be subjecting that distribution to tax and potentially penalty as well. So the definition of qualified education expense for each account type is an important consideration. So when we're looking at 529 plans, as I stated earlier, we have savings plans and prepaid tuition plans. We're going to talk about both. So let's start by looking at prepaid tuition plans. Okay, in a prepaid tuition plan, we're pretty much doing exactly what it sounds like we're doing with the client, right? We're purchasing college credits today for future use. Okay. Now, one thing that we have to understand about prepaid tuition plans is that they're sponsored by states. Okay, and to fund a prepaid tuition plan that is sponsored by a state, you have to be a resident of that state. And so if we have, excuse me, Texas residents that want to fund a prepaid tuition plan, then they can only fund the prepaid tuition plan in the state of Texas. They can't fund a prepaid tuition plan in the state of North Carolina or New Jersey or whatever the case may be, just in the state in which they're a resident. And another thing that we have to understand is that the credits can only be used at full value at colleges that are part of the state university system for the state of residence. So again, if we have a client that's funding a Texas-sponsored prepaid tuition plan, the credits inside that plan are only going to receive full value if the student attends a state university in Texas. So that's a big limiting factor of these plan types, right? What happens if the student attends a private institution in the state of Texas? Or what happens if the student attends an institution outside the state of Texas? These are definitely considerations that we would want to plan for as we consider the use of a prepaid tuition plan. So just to touch on that a little bit, more often than not, if a student ends up attending, I'm going to call it a non-sponsored university, right? A university that's not a state university inside the state of residence, then one of two things is most likely going to be the case, right? Either the institution is going to accept the credits at partial value, or the institution is not going to accept credits from the prepaid tuition plan at all. Okay. So the partial value acceptance, I guess that's not the worst thing in the world because the credits still can be applied to offset the cost of the college education. When the university potentially doesn't accept the credits at all, this is kind of worst case scenario, right? So what do we do if the student ends up going out of state to a university that does not accept credits from the prepaid tuition plan? In that case, the account owner would have to take a distribution back from the plan, right? And when the owner takes the distribution back from the plan, it's considered a distribution of basis, right? So there is no tax consequence, but there is also no gain, right? So if a parent buys $100,000 worth of prepaid tuition credits when a child is 5 years old, at 18, the child goes to university that doesn't accept those credits. The parents can recoup their $100,000, but only at the level of contribution, right? They're only going to get $100,000 back. There's going to be no gain on that $100,000, and there's going to be a lot of opportunity cost based on what that $100,000 could have been used for if it wasn't sitting in the prepaid tuition plan. So those are things that we definitely have to consider. Another thing to consider with prepaid tuition plans is, let's say that we have a student that's a resident in the state of Texas and they apply to 3 different universities, right? They're like, I want to stay in Texas. The parents are like, yeah, you do, because we're going to make sure that these credits have value and you're going to go to a public school, right? And so student goes off and applies for their top 3 choices in schools. Well, let's say that they don't get admitted in University 1 and they don't get admitted in University 2. The only university they get admitted to is their 3rd choice university, right? Now they have a lot of restriction on where those credits can be used, because they might say, oh, I don't really want to go to my 3rd choice university. And so let's open up the search. Well, you've already chosen all the top state universities that you would be interested in attending. If you want to use their credits at the full value, now you can only look at state universities that weren't really on your list to begin with. You don't have the option to say, all right, well, now I'm going to consider XYZ institution because I want to continue to explore my options. And so it can be potentially limiting in the college choice at the end of the day. Now, one thing that we also need to know from a tax perspective is, let's go with best case scenario here. The student chooses a state university in the state of residence, and they're going to use their prepaid tuition credits at their full value. Awesome. Well, when the credits end up being applied to the cost of tuition in the year of attendance, there is no tax consequence on the gain. All right, so I'll give you a basic example. Let's say that a parent buys a credit for $500. And then when they apply that credit to the cost of tuition at the state university that their student is attending, the cost of a credit is $1,000. So they paid $500, but they get $1,000 value. Well, inherent in that is a $500 gain on the value of that credit. As long as the credit's used to fund the education, which basically that's your only option, there is no tax consequence on that difference in value. So that's where the tax-free growth and essentially tax-free distribution takes place with regards to this type of plan. Let's take a look at 529 savings plans now. So 529 savings plans are a little bit more flexible. If we go back real quick to prepaid tuition plans, the only thing that meets the definition of a qualified education expense under that plan type is tuition and fees. Okay. Well, when we move to 529 savings plans, the money sitting inside these type of accounts can be used for tuition and fees, room, board, books and supplies, equipment, basically everything. So there's a lot more flexibility with use. 529 savings plans also don't they don't discriminate against in-state and out-of-state institutions. They don't discriminate against public and private institutions. You can basically use the funds at any institution. You also don't have to choose the 529 savings plan that is sponsored inside your state of residence, right? 529 savings plans from other states oftentimes accept contributions from non-residents participants. So there's some flexibility there. Basically, what you can do is go out and choose the 529 plan that you think best suits the client's education funding goals. Okay, so the way a 529 savings plan works is clients make after-tax contributions, right? There is no federal tax deduction for contributions made to a 529 savings plan. Now, if you live in a state where there's state income tax, it's possible that there would be a state income tax deduction for contributions to this type of account. But at the federal level, there is no tax deduction. So contributions go in with after-tax money. The money inside the 529 plan grows tax deferred. And if the distributions are made for qualified education expenses, then the money comes out tax-free, right? So if you contribute $50,000 and take out $100,000, as long as the distributions are for qualified education expenses, there is no tax at any point in time on that $50,000 worth of gain. And so that's an advantageous feature of this plan type. Very similar to the tax treatment, or really exactly like the tax treatment of a Roth IRA. So we really like that. We really like that tax treatment from a distribution perspective. Okay. Another thing that's really popular with regards to 529 plans is that there is no annual contribution limit and there is no AGI phase out. So a lot of accounts that have tax preference associated with them will limit who can participate in the tax benefits of those accounts. Let's use a Roth IRA as an example, right? Roth IRAs have AGI phase out limits that basically say if you make too much money, you can't make contributions to this account, which ultimately means you don't have access to tax-free distributions in retirement from this account type. Now, there's ways around that. You can talk about that in retirement planning. But generally speaking, that's the rule. Okay. But with 529 savings plans, they're basically saying, we don't care how much you make. You can take advantage of the tax benefits associated with this plan type, regardless of income level. And they also don't restrict the contribution amounts, right? So again, let's compare it to a Roth IRA. A Roth IRA says you can contribute up to a certain amount per year, but once you go over that, or once you get to that limit, you can't contribute anymore. A 529 savings plan says you can contribute as much as you want in any given year. So a really nice feature, again, especially for higher income households that want to use this as an education funding vehicle. Now, while there are no contribution limits from the plan's perspective, or from the IRS's perspective, I guess I should say, the plan may come in and say, hey, listen, we have a total contribution cap of, let's say, $500,000 in the account. So that's the maximum amount of money you could put in. Now, a client could go in and put the maximum amount in 1 year if they wanted to. But 529 plans do say, hey, listen, this is the ceiling for contributions to our accounts. Okay. Now, 529 plans offer a variety of investment options. Okay. 529 plans usually structure portfolios and say, hey, listen, we're going to give you investment options. We have portfolio A, B, C, D, E, F, and G. Okay. And those portfolios have different asset mixes, which means that they have different risk and return characteristics. And the client can go in and they can choose the portfolio that best suits their risk preferences, their timeline, and ultimately their accumulation goals. And so there's usually a pretty broad variety of portfolio selection options inside of 529 plans. And once you select a portfolio allocation, you're not necessarily married to that. 529 plans allow you to make changes inside the accounts. In fact, the rule for 529 plans is you can change or you can make 2 changes per year. Okay. And the most common changes are changes in investment options and changes in beneficiary. Okay. Where you can come in and say, hey, listen, child A got a full scholarship. They no longer need the assets inside the 529 plan, but child B, it doesn't look like they're going to get the scholarship. So let's just change the beneficiary from child A to child B. Now child B is the beneficiary of the 529, and everything's all good. So that's a nice feature as well that adds to the flexibility of 529 savings plans. So let's talk a little bit about contributions to these plan types. It's possible that a client would want to fully fund a 529 plan up front, right? So they don't want to make monthly contributions for the next 18 years to a child's 529. They have cash available now, and they want to put that cash into the 529 plan immediately to fully fund the education goal. Well, one of the things that we have to consider, if that's the client's objective, is gift taxes. Okay. Now, one thing you may or may not be aware of based on your experience or the classes that you've taken to this point are gift tax exclusions. If we look at the tax system just from a very big picture, we have 3 different buckets that the federal tax system basically operates with. Its federal income tax. That's the one we're most familiar with. Then we have gift and generation skipping tax, right? Those are transfers to other people, and what tax consequences that might take place during those transfers, specifically in life transfers. And then we have the estate tax, right? The estate tax is basically a tax that occurs at death when there's a transfer of property that's large enough to justify taxation. Okay, so 3 different buckets that we're operating in. And so now we're kind of talking not about income tax, but transfer tax, right? Transfer tax in the form of gift tax. Someone giving assets to another for another's benefit potentially triggers a taxable event. Okay. But under the gift tax system, there's an annual exclusion for gift tax purposes. And for 2024, that annual exclusion is $18,000 per year. So let's talk about how this works. If we're looking at that $18,000 annual exclusion amount, let's say that we have a child that comes from a married filing jointly household. Okay. In this case, this is how the gift tax exclusion works. The couple can choose gift splitting, right? They're a married filing jointly household. And when we say gift splitting, basically what that means is that the husband can give a gift, and so can the wife, right? Spouse A can give a gift, spouse B can give a gift. Okay. And they can both be up to $18,000. So really, when we're looking at this, the couple can give a $36,000 gift in 2024 and be under the gift tax exclusion amount. All right. Now, what happens again if we have a married filing joint household and they're sending a kid to college and the college expense is going to be $150,000 and they want to fund $150,000 for that child in 1 year? Well, what 529 plans say is that you can use a 5-year averaging election to make large contributions to the plan in a single period. And so basically what they'll do is allow you to make up to 5 years worth of gifts, applying the gift tax exclusion to 529. So you could make contributions under a gift splitting arrangement up to $180,000 and not worry about any type of gift tax consequences from that contribution. And so that's a really nice feature of these plans. Like I said before, as long as we're making qualified distributions, the distributions are going for things that meet the definition of a qualified education expense. Those distributions are tax-free. If we make a non-qualifying distribution, then we're going to be subjecting that distribution to tax and also a 10% penalty on that distribution. Okay, so that's something that we have to consider. Again, let's go back and consider an example where we have a 529 savings plan. The child gets a full ride scholarship for their education, and now the parents are sitting on this money. Well, they don't have another beneficiary. What are they going to do? In a worst case scenario, they would say, all right, I guess we'll take this distribution. We'll recoup the money, and at least we have it. But when they take the distribution, because it's not for qualified education expenses, the distribution is going to be subject to tax and penalty. But not all is lost, right? They still get to participate in some of the gains. Those gains are just reduced by the tax and penalty. The Secure Act 2.0 came out with at least a partial solution to this problem. They said, and I believe it's $30,000, don't quote me on that. They said up to $30,000 can be rolled into a Roth IRA, right? So for $30,000, you get the benefit of using those assets for future retirement of a parent, let's say, without incurring any tax or penalty on the distribution to the Roth IRA. So that's a really nice feature. But the remaining amount, if there was a remaining amount, if distributed, would be subject to tax and penalty as a non-qualified distribution. The other option might be for the parent to retain that. And if there's a grandchild in the picture or an expected grandchild within a certain period of time, they could use those assets and change the beneficiary to that grandchild and just fund the grandchild's education with the 529 plan. So there is some flexibility, there is some options, but we just need to know that under certain circumstances, taxability and a potential penalty might come into play. Okay. Now, we've kind of already talked about some of these things. First thing is transfer of beneficiary. Funds can be transferred to a relative of the original beneficiary without penalty, right? But beneficiary changes may result in a taxable gift from the old beneficiary to the new beneficiary. We're not going to get into those rules for the sake of time, but just be aware of the fact that it's nice to have the flexibility of the beneficiary change, but depending on the circumstances of that change, it could potentially lead to a gift from old beneficiary to new beneficiary. Some other things that are probably more relevant are the last two bullet points, right? No double dipping. Basically, what that means is that you can't take a tax credit for education expenses that were paid for with a tax advantaged account, right? So if we pay for education expenses with a 529, then we can't also still take the credit for those expenses. So no double dipping on tax benefits. Another thing to be aware of is the favorable estate tax implications associated with 529s. Let's say that we have a parent that sets up a 529 on the behalf of their child. Okay. The parent is the owner of that account and the child is the beneficiary. Well, this is a really odd circumstance where the tax code allows for those assets to be transferred out of the estate of the parent. And so if we're dealing with a wealthy client that's potentially looking at estate tax consequences at death, one of the things that we want to do as financial planners is we want to give away as much of that estate as we possibly can while the client is living, so that at death, the estate for the parent, in this case, doesn't hit the books as a taxable estate. So this is one of the ways that we can do this. There are a lot of ways to do this, but this is one of them. What's odd about 529 plans in comparison to other strategies that financial planners use to remove assets from estates is that 99% of the time, the person removing the asset from their estate has to forego control of those assets. Well, in 529 plans, the parent gets to retain control of the account and get the estate benefit at the same time. Remember, the parent can change the beneficiary, the parent can change the asset allocation, and so on and so forth. And so maintaining control and removing assets from the estate is a rare combination, but 529 plans allow for that. I just talked about that. If you want to see some examples of 529 plans, here are some both savings and prepaid plans that are offered by the state of Texas. If you go to savingforcollege.com, you can look up plans for a variety of different states, and you can compare those plans against one another. It's a really nice tool for evaluation and plan selection. Another really nice tool for this is AARP's college savings website. This is a great tool for side-by-side comparison. When we get to the education funding portion of your case study project, these are tools that we'll definitely use for selecting an education funding account for our client. Before I get into grandparent-owned 529 plans, I do want to also talk a little bit about the benefits of 529 savings plans with regards to pre-K through 12 private education funding. Prior to, I think it was about 2015, 529 plan assets could only be used for post-secondary education. But around 2015, there was a change in the tax code that affected 529 assets that said that 529 assets could be used for K through 12 private education. Well, prior to that, Coverdell's were the only accounts that could be used for a K through 12 private school. So Coverdell's had a broad definition of qualified education expenses, and they could be used for K through 12 education, which made them really flexible in comparison to even 529 savings plans. And so people that like that flexibility and had a goal of funding private school before college might potentially use Coverdell's to meet those objectives. But once 529 plans came onto the scene with the same benefits, Coverdell's basically became obsolete. And the reason they became obsolete is because they have a very low contribution limit. Coverdell's have a contribution limit on an annual basis of, I believe, $2,000. So very low annual contribution limits, as to where 529 plans don't have contribution limits at all. And so Coverdell's may be pre-existing, but the likelihood of opening a new Coverdell account is not all that high. All right, so let's talk about grandparent-owned 529 plans. As we mentioned earlier, one of the things that we want to accomplish when we're considering funding a college education is protecting eligibility for other forms of aid, specifically government aid. All right, so if we're working with a client that is potentially going to qualify for government aid, and they have a grandparent that has saved some money through a 529 plan for the student's benefit, then we need to be really thoughtful about the distribution timing from that 529 plan, right? If the grandparent-owned 529 has enough money in it to fully fund the child's education, we're probably going to be a little bit less concerned, right? We have the assets in place regardless of aid eligibility to fully fund the education goal. And so that's one circumstance. On the other hand, let's say that we have a grandparent-owned 529 that doesn't have enough money in it to fully fund the college education, and we think the student might be eligible for government aid. Well, when we think about government aid, we need to know some basic things. Anyone that wants to apply for government aid has to complete a form called the FAFSA. You guys may know this based on your recent experience as you applied and became admitted to Texas Tech University and started paying tuition, right? So you got to pay the FAFSA. And the FAFSA is going to determine a number called the EFC, the expected family contribution, right? The higher the EFC, the less likely it is you'll qualify for government aid. The lower the EFC, the more likely it is. Well, when we have a grandparent-owned 529 plan, distributions that come out of this are considered student-owned, right? Student-owned assets are the type of asset that have the greatest impact on the EFC, right? The higher the student-owned asset, the higher the EFC, the less likely the student is to qualify. And so we may want to say, hey, listen, let's defer distributions from the grandparent-owned 529 plan until later on in the college education journey. And on the front side of this, let's maximize government benefits that will offset the cost of the education, right? And then once we get to a point to where the assets available in the 529 plan would fully fund the remainder of the education expense, then we can start taking those distributions because there's less concern about aid eligibility at that point in time. And so we have to be strategic about the relationship between grandparent-owned 529 plans and the EFC on the FAFSA and how that impacts distribution timing and our overall strategy for funding the education. Okay. All right. Let's switch gears here, and I'm gonna change this on the fly. Every now and then I'll get a number that sneaks through, and I'll notice it while I'm talking. And so right now we have an old IRA contribution limit. So let's just fix that while we're talking here. Okay, so it's not 2021 anymore. We have an IRA contribution limit in 2024 of $7,000 per year. And if the individual is over the age of 50, there's a $1,000 catch-up contribution, which means that the absolute maximum contribution that can go into an IRA account is $8,000 per year. Okay, so I like to talk about that because it's a stark contrast to the no contribution limit associated with a 529. All right, so when we're thinking about IRAs, let's really focus on Roth IRAs. And let's think about why someone might use Roth IRA assets as opposed to, let's say, 529 plan assets. Well, in the first circumstance, and let's stick with parents here. A parent might use Roth IRA assets to fund a child's college education if they just didn't save anything specifically for that education. So parents didn't save before the kid went to school. Now the kid's going to school and they want to help fund the education. And they're working with their financial planner and they're saying, what are our options to really help our student offset the cost of their education expenses? And the planner might come back and say, well, you've got this Roth IRA, right? Now, why would we care? Well, let me back up before I go into that. So that's one option, right? They didn't prepare, but they do have this asset that might be advantageous. The other potential scenario is the parent sits down with the planner and they say, hey, listen, we really can't afford to fully fund a college education. We don't know how much we'll be able to, or even how much we want to fund of the student's education, but we would like to have the option, right? But we want the most flexible option that's available. The planner might come back and say, well, let's use a Roth IRA in that case, because if you don't need the assets for education funding, then you can use the assets for retirement. If you do need the assets for education funding, then there's some really nice benefits with regards to taking distributions to offset the cost of college, right? So there's flexibility there in a Roth IRA where the parent can make a point in time decision on how to really use the assets if they're a little bit loose during the planning period on exactly what they want to accomplish with regards to education funding goals. Okay. All right. So why are our IRAs attractive? Well, the main reason IRAs are attractive is because qualified education expenses avoid the 10% early distribution penalty. Okay. So an IRA is a retirement account, right? And distributions taken before retirement are considered uh, premature distributions. And so if the account funds are being used for something that the account wasn't designed to pay for, then the way that the IRS incentivizes um, staying away from that type of activity is by enforcing a penalty. But they do give some exceptions, and distributions for qualified education expenses avoid the 10% early distribution penalty. And so that's why we even talk about this. The other reason we really like Roth IRAs is because it's likely that we'll be able to take at least a portion of the distributions tax-free. And the reason that the client would be able to take a portion of the distributions tax-free is because of the order in which distributions come out of a Roth IRA. Okay, so when we're looking at Roth IRAs, the order of distributions is contributions first, rollovers second, and earnings third. Okay, and the only portion of that distribution order that would be subject to income tax is earnings, right? So let's assume that the client doesn't have any rollovers, right? They just have contributions and earnings. Okay. Well, they can take distributions up to their full contribution amounts tax-free to fund college education expenses. This ends up looking exactly like the distribution characteristics of a 529 plan. And so these are really popular because of that characteristic. Now, if they take distributions above the contribution amounts, then they get into earnings, and then any distribution of earnings that are premature would be subject to taxation. Okay. So there's some nice flexibility built into this. All right. I'm going to skip over traditional IRAs because they really don't make sense. They would be an absolute last resort. The reason they don't make sense is because of the timing of taxation, right? For traditional IRAs, money goes in before tax, grows tax deferred while it's in the account, and then comes out as taxable money, right? So the really only benefit to using traditional IRAs is you get to avoid the 10% early distribution penalty, but every distribution that you take is going to be subject to taxation. So it's not near as efficient with regards to funding education. I would go as far as to say traditional IRAs aren't even as efficient as taxable or brokerage accounts, right? Taxable accounts are oftentimes referred to as brokerage accounts. Now, when we're talking about taxable accounts, they are exactly what they sound like they are. Earnings in the account are taxed in the period in which they're earned. Okay. So when we're talking about 529s or IRAs, we have tax deferral on earnings. For as long as the money is in the account, there is no tax because taxes are deferred in those account types. Well, in taxable accounts, there is no tax deferral, right? You're recognizing income on the investments inside taxable accounts in the year in which that income is earned. So you might have dividend income or interest income or even capital gain distributions from mutual funds and ETFs that would be taxable in the current year. All right, so that's a little bit less efficient. But when we think about distributions from taxable accounts, we can be pretty efficient from a tax perspective when making these distributions. And the reason for that being is because we can harvest, right? We can choose the assets that we want to distribute from the account, right? So let's use a very basic example as a hypothetical to illustrate this point. Let's say that a client has a taxable account with $1 million in it, and they need a $40,000 distribution to fund the education expense for a given year. Okay. Well, if the client goes to that taxable account and they choose assets, let's say they choose assets that they paid $10,000 for and have a $10,000 gain. Okay. So that's one that makes up $20,000 of the distribution, right? It's worth 20,000. They paid 10, it has a $10,000 gain. And then for the other 20,000, they choose an asset that they paid $30,000 for, but had a $10,000 loss, right? So it's also worth $20,000, right? So they can sell a $10,000 gain position to take out $20,000, and they can sell a $10,000 loss position to take out the other $20,000. And the $10,000 loss offsets the $10,000 gain, and there is no tax consequence for that $40,000 distribution. And so the moral of this story is that there is lots of flexibility, right? There's flexibility in how we make distributions to manage taxability. There's no possibility of being subject to a penalty, and we don't have to worry at all about what constitutes a qualified education expense, right? We're not using an education funding account. We are using a taxable account where there are no rules from an education funding perspective. And so lots and lots of flexibility. Some inefficiencies in the accumulation phase, but flexibility when it comes to distributions. And so not a terrible option to consider for education funding. Okay. Oh, darn it. I've got another oversight here. All right. So how do we hold accounts? We really want to make sure in most cases that the child doesn't have rights to assets at the age of maturation, right? And so based on account type, the age of maturation might be 18, it might be 21, and in some cases it might even be age 25, right? But more often than not, the parent is trying to control to where when the child turns 18, the money doesn't basically become theirs, right? They get to make all the decisions on distributions, how the money's used, what it's used to pay for, et cetera, et cetera. The parent likes to maintain control over those things because if you think back to your 18-year-old, 19-year-old, 20-year-old days, you have no financial experience, right? And you might be tempted to use those monies for something other than what they were saved for, right? So we usually like to set up situations to where the parent, the grandparent, someone with financial experience maintains control over assets. Okay, I'm not going to talk about UGMAs and UTMAs. If you want to look at them, there they are. And like I said at the beginning of this, there's a lot of different strategies that you can use for paying for college, right? We usually use some combination of savings, cash flow, aid, et cetera, when coming up with the best solution to this problem, right? Even when we think about combinations, we might say, hey, listen, our client wants to ensure that tuition and fees are covered. And so they're going to use a 529 prepaid tuition plan to guarantee 4 years of tuition and fees. They're not sure how much of the remainder of the expense they want to or even are able to cover. And so they'll make contributions to a 529 savings plan to cover some of those costs, but that's not the main goal, right? The main goal is tuition and fees, and whatever ends up in the account for the 529 savings plan is just a bonus, right? So lots of things to consider with regards to options. Okay. Goodness gracious, this $15,000 really snuck its way in here on multiple occasions, didn't it? So paying out of cash flow, the biggest issue is gift tax consequences and then financial aid issues. that might come into play. Okay. All right, let's look at some questions here. Your married clients want to gift $100,000 per grandchild into tax-deferred accounts that will get the money out of their estate this year. Which is the account that will meet their goal? Well, remember talking about gift splitting and the 5-year averaging rule. Married clients could give up to $180,000 in a given year to any individual, right? And one thing that we need to know is that that's not capped for all individuals, that's per individual. And so if they have multiple grandchildren in this case, they can give up to $180,000 per grandchild based on gift splitting and 5-year forward averaging if they use a 529 plan. I'll give you a piece of advice. If you get stuck on your quiz for Unit 5 and you're like, I don't know what the answer is, there's a 75% chance that the answer is 529 plan. So just a little tidbit there. What if they want to retain the right to change beneficiaries? In this case, they could change beneficiaries in the 529 plan. Okay. UGMA's uniform gift to minor accounts. These are also estate planning tools. I skipped over UGMAs earlier. The reason someone might use an UGMA is to get assets out of their estate and to have more flexibility on the assets that they move out, right? When we're looking at 529 plans, we're only able to really move cash out of the estate. But with UGMAs, you have a little bit more flexibility on the type of asset that can be used to fund the UGMA, which is basically a trust account. And so you can move different assets out. The reason people generally don't like UGMAs is because of the age of majority. I believe the age of majority on an UGMA, let's go back and look at it just to be sure, is 18 years old, right? So basically the child becomes the owner of the assets in the account at age 18. And so they're not super popular for that reason, but good for moving assets out of the estate. This is one where the parent has to give up control of those assets, so they don't have the ability to change beneficiaries because of that loss of control to move the assets from the estate. So just the 529 plan on the beneficiaries. Your young clients would like to save for a private high school education for their newborn child, which the following accounts would provide a tax advantage and meet this goal. That would be Coverdell's and 529 plans. They're the only ones that allow for qualified education distributions for K through 12 education. Which of the following have the most restrictive definition of qualified education expenses? That's going to be U.S. savings bonds. Now, 529 plans is also on the list. 529 prepaid tuition plans also have a very strict definition. Both savings bonds and prepaid tuition plans only treat tuition and fees as qualified education expenses. 529 savings plans, as we know, treat everything as a qualified education expense. If a 529 savings plan is open with Lulu as the beneficiary, could the beneficiary later be changed to her sister, Lily? And the answer is yes, with no penalty. All right. Well, that concludes our discussion on education funding ways to pay. The next topic that we're going to look at is an education funding needs analysis, and we'll be back with another video on that.